What up? How you guys doing? You already know who it is. It's on the screen. Wanted to drive by this evening and speak to you guys a little bit about it possibly being too late for some folks to buy. I want to present a case looking at data, no emotion, no hype to make my case. For those of you that may be on the sideline and are waiting for home prices to come down considerably, 50, 75% corrections, and interest rates to go back into the 2% range. So, again, I want to talk to you about that. Allow me to make that case, and we're going to get right into it. Okay? So, let's do this. What you're looking at, and I'll start over here. No investment advice. Okay? Uh, invest at your own risk. But these ticker symbols, Investco, right, and American Homes for Rent. Okay, they're both publicly traded companies, and I'm going to look at their prospectus, if you will, for investors or potential investors to read to make the case that if you are on the sideline because you're waiting on these numbers to come down to a point to where you're ready to buy, you may not want to do so after this video. So we want to start with Investco again. Here's the ticker symbol in case you want to do some research on your own and maybe buy some stock in real estate. Um, believe they also have a REIT, might even be paying a dividend. Again, I'm not, and this is not investment advice. I'm just using this as an example. So here, let's switch them over. So my point I want to make with Investco is as follows. Let's scroll down here. They have a three-headed strategy, three-pronged strategy to their investment portfolio. But traditionally, they've been over here in the apartment segment. Okay. Uh, there's something fairly new or new to Johnny come latelys, but it's called build for rent, single family residence, where the whole community, master plan community, is built for the purpose of renting out each unit. And then, you got your scattered single family residences, which was typically dominated by mom and pops, things of that nature. So this is their investment strategy. Interesting on the duration, the typical stay that they say folks live in these places, right? 3 to 4 years, 3 to 4 years, 1 to 2 years. And the reason that I can appreciate this perspective, and maybe you can, is because the information is not coming from me. Because some of us are from the mindset that if it doesn't come from a certain place, that it's not true. But what I will agree upon is these companies, right? Publicly traded companies, we know they have the bag. Okay. These folks are really in business and they don't get hyped up off of emotion and celebrities and go invest money, but they do market research, so on and so forth. So this is why I appreciate this. And I get it. I'm not these folks, right? You don't know who I am from the next person online. So let's present the case. Okay. So Investco, been around a long time. I'll let you read about their provenance. But again, here's the ticker symbol, right? Publicly traded company. And so with that being said, what's interesting to me is they talk about their fundamentals of single family resident demand drivers. What's driving them to seek funds from their investors to make a profit, right? To have a return. These are the things that they see. This is where they put their money to do their market research, right? And so um, This is something that we've been saying at nauseum, we, the professionals in the space. But right here in this first column, let's highlight it. Will it let us highlight it? Yeah. So the single family totals about 15 million units, similar in size to the traditional rental apartment market, right? It is long accepted. It's a long accepted component of the rental housing market. Okay. But here's the key. But until recently, right, this space has been dominated by mom and pop owners. And due to the technology that we're all experiencing, even me being able to make this video for you now, and you can watch it on your device. A lot of you guys watch on devices and things of that nature. But technology is a disruptor. Okay. You can't let that go over your head because this is what has made real estate in all of its different variations, okay, more attractive to institutional investors because they're about making money, economies of scale, efficiencies. So technology, okay, now let's look at some of these mom and pops because we know that they're running these things efficiently now on the inefficiently. Now on the flip side to that is there's competition, mom and pops. And anybody that's watching that's an investor, you guys know what I'm speaking of, right? At one point in time, a man or woman could get out here and purchase properties and amass $1 million portfolio. And it might have been some headache, this, that, and the third, but it was enough inefficiencies involved in the process to where there's not a lot of competition. Not the case anymore. Let me move on. Here's the point I want to make about the actual potential home buyer, right? Strong demographics, lifestyle tailwinds driving demand. Okay. And this is what they're citing. Aging millennials should drive strong growth in the prime single family resident household formation renter age, that cohort between 35 and 44. Spot on. They're right. They're factual. Okay. They've done the research over the next decade. That's the next 10 years. Okay. Now, as millennials reach adulthood milestones, getting married, starting families, having a partner, right? We don't want to offend anybody. Uh, they will likely seek larger living units. Makes sense, right? We need some more space. Okay. Millennials value optionality provided by renting, the ability to be more mobile. And that's true. I deal with you guys a lot, and you want to feel like you have options. You want to feel like you're mobile, but I challenge you to really look at your numbers to see if you have options or if these folks are just placating to what you want to feel. And are you really mobile? Okay. Most people live within 15 miles of where they grew up. Facts. All right. Moving forward, affordability. So, student loan debt, okay, uh, and an impaired, a challenged, a struggling balance sheet is impacting and or delaying millennials' access to home ownership, right? That's true. A sizable share of older households have um, impaired credit or bad credit, challenged credit, locking them into long-term renting. Okay. And home prices have outpaced income over the past decade. Accumulating down payments can be challenging. So, home prices have outgrown wages for some, not for all, because folks are out here buying. Okay. Just want to paint the picture to you on how these institutional investors have gone in to basically find out what the problems are, which we can solve all three of those problems. If you're a younger person, as I digress, well, as I go on a rabbit trail, if you're a younger person and you don't know what you want to do, don't go to college and amass a lot of debt. All you have to do is turn on the news, Google, TikTok, and listen to all of these older folks that don't want to pay for their student loan debt that nobody made them get into, um, my opinion. But they don't want to pay for it. And the reason why is because more times than not, the pay is not commensurate with the debt. So if you're someone who has not done that, there are a plethora of options that you can explore that will keep you out of that debt, i.e., make you more viable to purchase a home when that time comes because you won't have that burden on your back. Those of you that have the debt, no, I'm not that's not an aside to you or anything of that nature, but there's several options to help you manage that debt so that you can focus on the main thing, which is securing real estate. Now, credit is something that I guess, you know, uh, excuse me. What do I want to say about credit? Some of us got to grow up with the credit. When this trended data hits and your history going back as far as 36 months is really implemented, it's going to hurt a lot of folks. Again, young folks, here's the formula. Don't borrow anything that you don't intend or cannot pay back, okay? Because it's going to haunt you. These are all things that are cited on this Investco prospectus for potential investors that say, hey, these are the tailwinds. These are the things that are pushing the group of people over the next 10 years that I know have to rent. They don't have no choice. All right. They can't afford it. They got too much debt and the credit is bad. But again, we have solutions for those. Not going to talk about it tonight. Just making the case to you all to show you the importance of single family homes and how these investors are going about determining where they're going to put their money, right? So again, here's the ticker symbol for Investco. I'm not an investment advisor and I can't give that license, but maybe you'll say, hey, you know what? If I can't buy a home, maybe I can invest. I could get in the way of some growth. Just throwing it out there. You do what you want, right? So now here's the last thing I want to say, and then we'll move on. Housing production has lagged. Again, guys, there is not enough homes, exacerbated by 2 points. Almost 40% of people that own homes, they're free and clear. They don't have a mortgage. The rest, a big chunk of those folks, right, uh, have have interest rates below 4%. So that one other thing, older folks are aging in place. They're not moving around. So those three variables are not putting the normal inventory, the used homes, if you will, into the market because of those things that are happening. Now, all of that said, there's a lot of you that can afford to buy now, but millennials in this 35 to 44 year old cohort, you really haven't experienced a real interest rate. You think interest rates are supposed to be sub 3%, and that's not real. The reason they've been that way, as far as homes are concerned, is because after 2008 through 2011, when it was truly a housing debacle, right, that the housing bubble caused, and there was thousands and thousands of homes sitting empty, a lot of surplus, okay? That's why home prices were coming down, coupled with real risque type lending, okay? Builders have not kept up with the natural demographic growth from 2012 to today. They just haven't. So, not enough homes just due to the natural progression and growth of the demographics of the population, coupled with free and clear homes. Why would I go and buy another home? See, when you have options, you tend not to do those things. But just today, talk with someone who's, behind the eight ball, got to make a decision, and rent is going up, and they got you because of these things. Okay. So what else I want to show on this one? Yeah, let's look at some of the markets. The second investor, let me just show this one. This is called, excuse me, this is American Homes for Rent. I mean, they got a whole 300 home subdivisions. Okay. And let's look at, because they cite the same tailwinds, the same reasons why their investors should invest with them: student loan debt, higher interest rates, bad credit, and a real sensitive demographic cohort of people that don't understand an interest rate. That's not your fault. It is what it is. That's what you've seen, and that may be what you thought was the norm, because financial literacy is a thing, and a lot of us are illiterate. I was at one time as well. Okay, no disrespect, but that said, look at some of the areas, and I want to point out Texas because it's the main state, the home state. But see, right here in the Golden Triangle, all you Texans, they coming. I think Coach Prime said that, right? He said, we coming. But they coming. They come in here and they're coming to a lot of other states, right, for affordability reasons. But these folks, this company is in several top 30 markets, right? When we go to Investco, these are the markets that they're in. But Texas is in here heavy. So one of the ways that you can combat higher interest rates is by maybe moving out a little further, okay, or buying a little older property and using some finance strategies to update it to your liking. Again, financial literacy is the key, because these folks, they understand, especially American Homes for Rent. I visited one of the communities. It's beautiful. They got the little welcome center, a little pool. They cut the grass for you, right? And the rent's $2,000. And you might be like, oh, that's beautiful, right? But they understand the sense of community. They understand, hey, you might be here for 4 years. Their occupancy rate is 97%. And you're saying, well, Robert, why do you care? I don't. But I'm trying. I'm trying. No, I do care. Let me take that back. I do. Because some of you guys don't realize what you're doing. You see, before you know it, you could be renting for 10 years and the home prices are going to continue to increase. They might not increase at the pace that they have from 2020 to 2023, almost 50% due to what was going on. But the average appreciation is 3 to 6%, depending on where you are. So every year, look at it this way. Whenever you were a kid, let's say whenever you were 15, whatever soft drink, if you drink soft drinks or candy, that was your choice. How much did it cost? And does it cost the same today? And if it's the same cost today, do you get as much of it? Right? Inflation. Your dollar, right? Your currency is not purchasing as much as it did when you were 15. So there's only two ways around that, really, right? Is one, you could give up and live where you live, or you got to continue to produce or invest at or above the rate of inflation. Nobody wants to tell you that, but I will, because I do care. I do care, right? Trying to show you some of the things that I've done. Simple guy, but you got to get in where you fit in. All right. So these are some of the markets that these folks are in. And I mean, they're investing having money. Okay. So you got the big guys now that understand, hey, with technology, now it makes sense for me to get in, right? It's very interesting. Not just interesting. Hey, we've done our research. We know the top 25, 30 markets. Texas is heavy. Back to the Texans. There's some places where you could still find homes, nice homes, 200 grand. And the market that they're targeting is the entry level market, right? $200,000 to $350,000. I know that sounds crazy, but that's entry level, right? Because the dollar doesn't buy as much. Wood, lumber, nails, everything's up. So you have to wrap your mind around that. And you have to understand, what are the benefits? Why would these people be investing? Because Let me see if I could put this in real quick. If you guys are watching this at another time and you enjoy the content, uh, please let me know. Put a like in, right? Don't be a hater all your life. I'm just playing with you. Let's see here. Let me see if I can add something quickly. Because we can't, it can't be entertainment all the time, guys. You gotta try to learn something, man. You gotta try to learn something. So let's see here. I'll put that over my face. So this is a quadrant, obviously, on what you should be doing depending on, right? And this is Gravats. This is his source. But depending on where we are as far as a cycle is concerned, what you should be doing as far as investing. And I would venture to say that we're in this inflationary, right? Boom, where we still got economic activity, right? We're not in a disinflationary. Well, I guess you can say somewhat, depending on who you're talking to. You might say we're in a disinflationary boom because home price, we're not in a uh, uh, declining market, but due to some of the policy, it's a disinflationary, right? But I don't think we're in a heavy boom yet. I still think we're here. So when things are inflated, these are some of the things that you might want to invest in. Real estate, okay? Gold, commodities, high fixed cost, cyclical producers, right? And you want to sell long-term bonds. And that makes sense because if you understand mortgage rates and you look at the yield curve, when you hear the yield curve is inverted, the yield, the money made on the longer end of the curve, 30 years, 15 years, right? The yield is higher on the shorter end. The shorter maturity notes are yielding more. It's inverted. It shouldn't be that way. So, again, all the signs are pointing towards real estate as one of those things. Okay. Good thing. Now, to me, in any environment, it makes sense because the real estate really is a utility you're going to live in. And I'm not talking about all you investors and things of that nature. Some of us are just going to be employees. Okay. I don't want you to work all your life, not invest, not have anything. And you turn around and you look and you don't have anything. Get you something, right? That can increase benefit with inflation. I just told you over the average since they've been calculating these numbers with real estate, you call it a good 3-4%. And at best, for a lot of folks, it's a forced piggy bank. It's just like some of you guys getting your money back at income tax time. If you're working, that's your money. Okay. It didn't come from, we are the government. It didn't come from anywhere. That's just money that they took too much out of your check and they're giving back to you. Again, for those of us that are working, right? Same thing with a home. So it's not about a McMansion. It's not about 8, 10, 12, 15 units. Those are diversionary tactics, distractions, things that we use to not do the things that we need to do. I'm trying to show you guys that they got folks out here they in the game, baby. They in the game, right? So I think that's my point. Again, I might let this live for a little bit, but I want to show you, not entertain you, but show you that there's real folks, real money out here that you might be competing with. And it's not in a competition because there's levels. But this is the reason why there's a shortage of inventory because there's a lot of folks buying. You may not be able to afford, but there's a lot of you that can afford. And you have this misconception of where you think things should go because you may be listening to the wrong source. So hopefully this type of information can give you a sense of reality of what's really going on. And then you could try to make your decision off of information and not exploitation. Okay. Because ownership is at stake. It really is. There's a lot of folks willing, but they're not able. I pointed out why. And, get in where you could fit in while you could fit in. So as I get ready to get out of here, let's do this. Again, guys, Schedule a consultation. If you want to find out where you are, no pressure sales here. We're blessed. We believe that what's for us is for us, and we work with those who need to work with us. Uh, yeah, 4 people last week just wasn't a fit, or they had a better deal somewhere else, right? But if you want that transparency and you're not playing, okay, let me put some let me put uh some guidelines on that because some of y'all are line steppers. I'm not your personal loan officer, right? We'll have a consultation. We'll keep it business. We'll keep it a G, right? You guys know what that is. We're talking to adults, but don't try to take advantage because I'm not going to let you. But that said, schedule a consultation. Let's find out where you really stand. Let's see if we can work with one another. If we can, I guarantee you this. I'm not going to lie to you. I'm not going to waste your time because my time is, I love my time more than yours. So I'm going to respect yours, right? And we're going to do everything that we can do. We're going to keep our word around here, right? Word is bond. That's how I was raised. That's what I believe. So if that's you, let's have a consultation. Let's have a conversation. And that aside, man, ownership is at stake. Get in where you fit in. My time is up, but I thank you for yours. Hey, guys, as I always say, let's be good to one another. Let grace abound. And until the next time, peace. Y'all be blessed.